So next up, we'll be doing a Q&A kind of rapid fire session with Jeremy Lang, who is the co-founder and the portfolio manager at Ardevora Asset Management. So Jeremy is the manager of the Nedgroup Investments Global Diversified Equity Fund, a portfolio of about 150 to 250 equally weighted stocks. Ardevora use fundamental techniques to identify unusual behavior in global equity markets. They look at company management, analysts, and investors, and particularly the way they make decisions and the way they make mistakes. The theme of this session is vaccines mean a V-shaped recovery. So let's kick off with some questions for Jeremy. Jeremy, welcome.
Hi, Emil.
So can you please give us a short introduction to Ardevora?
Yep. We're a privately owned global equity boutique. We run around 8 billion sterling, which I think is about 160 billion in rand, for clients all over the world. We're quite a young business. We started in 2010 as a private partnership, which is where we remain now. Everybody who owns the business sort of works here. And because of that, because we're privately owned, we can do things sort of pretty much how we want. And our ambitions are fairly modest.
You're bottom-up stock pickers who are very interested in psychology and why people make mistakes. Can you please refresh us on how this actually presents in an investment process?
Yeah, so we're long-only global equity fund, and we have as the term goes, a bottom-up fundamental process. But we're a little bit different in the way we approach the fundamental, like stock-specific analysis. We focus on psychology, and we're most interested, as you mentioned, in why people make mistakes, including us. And we are particularly interested in CEO behavior. We believe CEOs are unusually untrustworthy, and we think it's far too easy to set plans for their businesses which are overambitious and unrealistic. And being on the wrong end of unrealistic, overambitious CEO plans is, in our experience, what makes stock market investing dangerous and painful. So we try hard to make it safer by trying to find the conditions which we think make it unusually easy for these sorts of people to strike realistic plans. And then as an extra insurance policy, we try and stick to business models which are less likely to blow up quickly if or when those plans go wrong. This kind of approach leads us broadly to two types of stocks, either kind of recovery stocks, which are reasonable businesses with a scar from unusually difficult conditions. In these, the CEO gets forced to change and focus on risk because capital markets basically pressurize them to do so. Those difficult conditions can either be fixed because they're largely self-inflicted, or they'll pass with time. And so in some sense, they're transient, if you like. And then the business can emerge stronger because the CEO has taken that opportunity to change and make the business safer. Investors often get scarred, I think, by that the sort of traumatic period which sets up those conditions, and then can be skeptical about recovery plans. Or the other type of stock is kind of completely different, plays quite a different behavioral cycle, and it's much more orientated around growth plans and growth stocks. Here, it's about trying to understand what makes an unusual business in an environment where it's unusually easy to grow. We know CEOs pretty much all like to be growth-orientated CEOs and have growth plans, but successful growth plans are not that easy to execute. But when you do execute them well, you build investor trust and belief. But the ones we're interested in are those sort of unusual ones which can sort of keep doing that for an unusual length of time. And our experience is analysts often underappreciate kind of how hard that is and the true uniqueness required. And they can think that the advantages of that will fade too quickly, and that's what gives you the opportunity.
Thanks, Jeremy. So that's quite a nice kind of nutshell look at the investment process. So what do clients actually end up with, and how does the fund behave over time?
So even though we spend our time trying to work out how other people are wrong, we know we're far from perfect ourselves, and so that has a knock-on effect to how we build our funds. And we try very hard to reduce the damage of our own mistakes. So that's why we like these kind of low conviction looking fund structure. So that means we have lots and lots of small positions. We're diversified by style and sector, and we don't take big regional bets or have favorite stocks. This focus on hoping for the best from CEO behavior, but if you like, expecting the worst and really spreading our bets means our downside protection and our upside capture numbers are quite good. And we've been able to perform in a pretty wide range of market environments.
Have a look at 2020 and how you actually navigated that. So, I mean, as you know, the fund performed exceptionally well over the year indeed. Before we get into a couple of the stocks, can you just please describe for us how you actually navigated such a tricky year?
Yeah, I mean, 2020 was a super interesting year. We started 2020 in I would say, a fairly cautious frame of mind. We do the same thing at the start of every year, which is that we kind of review the previous year and we try and get a handle on where we think the kind of consensus is in terms of investor behavior. And we do that by trawling through all of the most read headlines from the previous year and all of the strategy pieces that sort of emerge at the start of the year, which are making forecasts about what they think is going to happen. So if we go back a year ago, there'd been a lot of anxiety in 2019 around Trump's trade war and whether the Fed would get skittish about inflation and raise rates. And a lot of this anxiety had unwound by the start of 2020. So the consensus seemed to be pretty relaxed about global growth. And most strategists were advocating putting money in riskier stocks, in riskier markets, things like sort of small cap value cyclicals. We felt that CEO behavior had been getting kind of, if you like, a bit more lax and relaxed and risk loving during the year. And we still felt there was plenty of risk around. So when we put those two things together, we decided it was kind of sensible to shift a little bit out of some of the previously successful recovery stocks that we'd had from 2019 and go back into stocks which were more kind of steady, conservative growth plans. So it was a sort of reactive move, if you like, of where we felt the temperature was on investor sentiment. In early February, we began to notice some strange things coming out from the CEO statements in some of our stocks, which had supply chains heavily reliant on Chinese factories. Some of those companies started to miss their plans, and they blamed factories remaining shut following the Chinese New Year due to some new inexplicable virus. And the CEOs were mainly dismissive about this, but we didn't like the sound of this. This was causing a kind of unusual supply chain shock and was making it kind of uncommonly easy for previously kind of relaxed growth plans to not quite, sort of match what things were going. So we bailed out of some of those stocks that we owned that we felt were especially vulnerable to that supply shock, which were mainly in the electronic components sector. So before COVID really started to rip, we'd managed to position our portfolios quite defensively, but we'd done it in quite a reactive way. It's important, I think, to say that we did not see COVID coming, and we were not taking bold predictions about there being an imminent global recession. We were just sort of reacting to what we were seeing emerging from CEO, analyst, and investor behavior. And when the pandemic really hit, the stock markets panicked and everything got clobbered. We went down with the rest, but not quite as much. And so we got a bit of downside protection. In April, we were feeling, I would say, pretty traumatized and pretty gloomy like everyone else. And we tried hard to resist the temptation to run for cover. So instead, we started to trawl through the stocks which had been particularly beaten up. That's because we felt that there were some pretty unusual conditions around, which in our experience of the kind of investor psychology cycles made it unusually easy for investors to overreact and get kind of way too anxious. And at the same time, we could see that the CEOs that we watched, kind of wherever we looked, were unusually willing to abandon their previously kind of trashed plans and embrace recovery plans in quite a detailed way. And that's pretty unusual. Normally, they're quite reluctant to admit that things are kind of going out the window. And also, we could clearly see the governments were really pulling out all the stops and trying to hold the economy together. So we started to look for recovery value type stocks pretty hard, especially those in the particularly hard hit areas of the pandemic. It took us a bit of time to assemble some ideas, but by the end of May, we had shifted our mix much more towards those kind of value recovery sort of stocks, because we just felt that the conditions were there to make it more likely that they were going to work. We didn't do a lot in the third quarter. We basically felt that the markets and economies were essentially on a recovery path, even though there was still sort of an immense amount of bad news coming out. And that's really to do with the kind of psychology around people the way they cope with a new risk when it arrives. It's basically anxiety goes down with time as you begin to learn more about the risk which you hadn't appreciated before. And exactly that pattern kind of emerged with COVID. And what that does is it allows you to sort of adapt and kind of partially normalize. And so we could see lots of evidence of both businesses and people kind of adapting to cope with the pandemic. And so we felt essentially there was this sort of behavioral cycle where anxiety and fear was receding. And so we were expecting this to give a kind of upward push to recovery stocks, because what drives them is this sort of slow release of anxiety. Finally, by the fourth quarter, we were able to do what for the first time since kind of January 2020 felt like a kind of normal portfolio review, and kind of just look for new ideas sort of anywhere really without trying to be too reactive. And so we went looking for, growth plans and recovery plans. And we also, because we always do pick stuff that doesn't work, we had a hard look at a number of our existing holdings and identified the ones where we felt the path of recovery just looked like it was starting to get more difficult. And then, as we all know, the vaccine news hit, and the recovery stocks really ripped upwards. And we were able to do quite well in that vaccine rally, as we still had, kind of roughly half of our portfolio in those sort of recovery plays. So we ended the year in a pretty reasonable state. But yeah, it was wild.
It was wild. Thanks, Jeremy. And just specifically focusing on the fourth quarter, let's have a look at some of the stocks that did well for you and some of them that actually didn't do so well. So starting off with kind of the growthy side first, maybe if you can please tell us a bit about Trade Desk.
Yeah, Trade Desk is a super interesting business, and I'll just preface this by reminding you that we really don't have any favorite stocks. We've got around 200 stocks, and of course we love them all until we don't. But Trade Desk is kind of interesting. It's an US online advertising platform, which sounds a bit kind of jargony, but basically they kind of automate what media ad bars used to do for ad agencies, and they give a lot more insight into how effective adverts are without having to rely so much on Facebook and the Google ad systems. We like them because they have this kind of unusual business model, which we've come across in a number of different areas, which makes them kind of unusually effective. And basically, it's quite a difficult business model to screw up if you built it properly. And that's basically it's what we call a marketplace model. So it's pretty simple. It's just you form this kind of virtual market where you just bring buyers and sellers together, and you can apply that to lots of different things, and they just basically apply it to ads. Now the thing is, if you control that market and you match the buyers and sellers, you can gather lots of data about how people behave, and you can build software and data analytics around that to kind of upsell to users on both sides of the market. So it kind of fits what we like out of a business model. We thought analysts were kind of struggling to understand how unusually good that business model was, and also analysts and investors were a bit nervous about how that kind of business, because it's related to advertising, would cope with a recession. And so there was a bit of anxiety floating around about how they cope with COVID. But what we saw as the year progressed was that actually COVID turned out to be a kind of net boon for them rather than a kind of drag, because it accelerated the shift to the kinds of services that they provide for advertisers, so that we kind of got the double benefit, if you like, of a kind of growth stock, but in an area which was also expected to the end demand was expected to accelerate. So that was kind of cool. Yeah. Should we try another one?
Yeah, sure. How about CAE on the value side?
Yes. So CAE, again, it's kind of pretty unusual business. It builds and runs flight simulators to try and to train airline pilots. They've got a super strong position in that industry, and it's quite difficult for new competition to break in there because there's a lot of complexity and regulation around safety, and you've got to have quite close links with the companies that make the planes. And CAE has all those and has been doing it for a kind of really long time. Now, any business that kind of trains airline pilots, you would expect to get pretty duffed up during the pandemic that we've had, because, as we know, a lot of planes have been forced to sit on the ground and people just really haven't been flying around a lot. So they got really, really clobbered in the early part of the year as the pandemic rolled through. But the thing about CA is it's basically a much better business than both its customers and the OEM plane makers, because you kind of sort of have to keep training pilots whatever happens to your end demand. And also what we found pretty quickly was that they were hit a lot less badly than analysts expected, even though there weren't a lot of planes flying around, because the airlines had to kind of shift the types of planes around in a much more opportunistic way, and they actually had to kind of they were forced to sort of retrain pilots to be a bit more flexible. And also there was this kind of extra factor of what was going on with Boeing, with some of the problems that they'd had with their MAX aircraft, which had been grounded for safety reasons, which also kind of released a whole pile of training demand for CAE as they tried to bring that plane back online. So you sort of had an experience where it was a lot less worse than feared on the way down, and then the recovery came through kind of more quickly than people expected, particularly given that you've not been able to fly very much. And then kind of fourth quarter was all about people imagining what life could be like without the pandemic. And of course, it's very easy to imagine you hopping on a plane and flying to a nice resort somewhere and flying planes more. And CA is obviously going to benefit from that. So the stock price did particularly well in the fourth quarter.
Thanks, Jeremy. So we only have about a minute left. So I guess I just want to ask you to finish off. Just my last question is, what about your thoughts for the year ahead?
Yeah, so we've done the same thing this year as we tried to do last year. We kind of read all the headlines from the previous year, look at the strategy pieces, and try and get a sense of what the consensus is. And it looks like kind of everyone basically thinks that a vaccine means a V-shaped recovery, and this means most strategists are advocating putting money, bizarrely, in exactly the same things they were thinking you should put your money in last year, which is riskier markets, small cap value cyclicals. We're pretty sure that there is going to be an economic recovery. It's just we're a bit more skeptical about how quickly that's going to happen. Vaccine rollouts have to go absolutely flawlessly, and we don't think governments are going to be able to relax and allow herd immunity to be achieved with at least a little bit more stress through the healthcare system. And it's stress in the healthcare system which really determines how governments react and whether they insist on lockdowns or not. So our sense is that the recovery is going to be a lot less straightforward than the consensus believes. So we haven't done anything yet, but we suspect that a bit like this time last year, we're going to start to shift away from recovery stocks and back into more of those safer growth stocks, because in the end, we just basically like being a bit contrarian.
Jeremy, that was brilliant. Thank you very much. And we look forward to the continuing good returns.